guys, welcome to Learn Extra Live. Grade 12s, it's finally business studies. I know you guys have been dying for it all week, but yes, we are here, and we are here to save your lives. I know we always save your lives. But of course, you can join us on Facebook, facebook.com/LearnExtra. Our Twitter handle is @LearnExtra. These are the platforms where you guys can get chatting to us, ask any questions that you need to ask about business studies. Let's get into it, guys. I mean, it's such an interesting topic. Today we're doing, Tanya, do you want to let us know what we're doing today?
Today we're going to be doing one of my favorite topics. Today we're going to be looking at insurance, assurance, and types of investments. So yes, today I'm going to get really excited.
Okay, thank you, Tanya. You hear that? We're going to get exciting today and excited. Make sure that you jump onto the page, guys. It's really, really important that you guys ask Tanya questions, because that's what she's here for. And thank you to Macmillan for bringing us such an awesome session, guys. We really enjoy having you guys and Macmillan here. So, hey, stay with us and you will go far, I promise you. Over to you, Tanya.
Cool. So guys, like I said, assurance, insurance, investments. The first thing I want to look at, we're going to start with assurance, get into a little bit of detail, then insurance, and then very, very briefly we're going to go into types of investments, and that touches on forms of ownership. At this stage, you guys should have done quite a bit of forms of ownership. So when we get there, just get on the bus, and as we go through it quite quickly, we can do it. So let's do the first thing, assurance. Let me find the slide. And that's what we're doing. And assurance. Now, assurance and insurance, the easiest way to remember between the two, there are very few things in life you can be assured of. And as I said that, I'm sure the majority of you already thought of that. So assurance is basically a type of a type of insurance for something that will happen. Now think about this logically. What is the one thing that will happen to all of us? Death. As sad and as what it is, just the easy way to remember. So we're all assured of death. So assurance is a type of insurance for when you pass away or when you retire. So let's have a look at the definition. So assurance is a long-term life insurance providing cover for your life, health, and well-being. Now, individuals can insure their lives so that in the event of death, business partners or family members will receive an agreed sum of money. Now, life insurance policies can be used as security by individuals or businesses to obtain loans. So I want to get up to there. So with assurance, people assure their lives to look after their families, for example, after they pass away. We're going to look at types of insurance shortly. But people can also use these policies to cede against bank loans, for example. So, for example, if you want to take out a loan, you have to give something in return, or not give something in return, have something available for the bank. And you can use these policies to loan money. So that's it's a handy thing. So let's carry on with this. Now, life assurance can be bought directly from a company or through a financial service. So you can either choose to do it yourself or through someone else. But what I really want to get into is this part here. So in the case of assurance, cover is provided against a risk that will happen, death. Like we've discussed, so remember, assurance, it's something that will happen, and we all know this will happen. So the two main types really of assurance, the first one is whole life policy, which provides for a payment after the death of the insured, with the idea of providing for the dependents of the deceased. So a whole life policy really looks at only after a person has passed away and money that's been kept to look after that family. So somebody passes away, obviously there are people left behind, and those people need money to survive. So a whole life policy looks at looking after your family after you've passed away. Then you get a second type, or one of the two main types. So the second type would be an endowment policy, which will provide for the payment of a basic sum at a certain age, or on death of the insured, whichever one occurs first. That makes a lot of sense. Now, this will provide for the dependents, but also provides a useful sum of money for the insured if they survive the period. And what's meant with surviving the period is literally if you decide you want to retire at 65, for example, you will receive money. It could be either in a form of a lump sum, monthly, but that will look after you when you've reached 65. And in the case of this, like the definition tells us, it will be on your retirement or on death. Now, obviously, with death, your family will reap the benefits of the money you've put away. Let's carry on. The next page looks at retirement annuity. So following on, and you need to know this in grade 12, following on from assurance would be retirement annuities. Now, retirement annuities and pension funds go hand in hand. The difference between the two really essentially what you need to know at this stage would be the tax implications of the difference between a pension fund and retirement annuity. And the nice thing is you don't have to know that in detail, you just have to know that there's a difference. So let's have a look at a retirement annuity. Now, a retirement annuity, or an RA, which is the abbreviation, is a personal pension plan for retirement. So when you stop working. Now, you pay a monthly, annual, or lump sum contribution, and these funds are then invested by the insurance company. So with a retirement annuity, the company takes your money and invests it for you. So it takes the responsibility or that stress away from you. So on retirement, you get the money you put in plus extra. Let's do the next point. So a retirement annuity policy can only mature once you've reached retirement age. And currently this is 55 years old or older. Now the very important word here, guys, retirement annuity policies can only mature once you've reached retirement age. So you can't take out a retirement annuity, for example, and decide you want to retire at 35 and you're going to take the money. So according to current law, the youngest age you can retire at would be 55, and then you can start claiming the benefits of your retirement annuity. If you rather want that money, if you think, you know what, I want to be a millionaire by the time I'm 35, rather take that money and put it in unit trusts or something like that, because those don't have the same legal requirements, for example, as an RA, which would require you to be a certain age before you can reap the benefits. I'm not going to go into too much detail on the RA. I want to go into insurance. So let's have a look. Insurance. You can also, what I don't cover, you can always grab the notes. So what is insurance? Now, insurance is a contract where a company, the insurer, undertakes in return for receiving a premium from the insured, the person who's buying the insurance, to compensate the insured in the event of a specific event occurring. Wow, that's a really big sentence. Let me make that short and easy to understand. So insurance is basically you taking out a policy to protect you against theft, fire, something like that, and the company will take that risk on the basis that you're going to pay them for it. And only if something happens, you will receive that money. So an example would be if you take out fire insurance. Unless there is a fire at your company, at the business, at the factory, you're never going to receive that money. It is basically you buying peace of mind that if there ever is a fire, you'll be covered. But if there isn't a fire, alas, it's gone. Okay, so remember that. So that the difference with insurance and assurance will be assurance, it will happen. Insurance, it might happen. So keep that in mind. Next point. Now, such an event or peril, remember this could be fire, theft, can be a loss, such as goods stolen, fire, theft, or motor vehicle accident. So these are the types of things you can be insured against. Now, we take out insurance to guard against the risk of loss, theft, fire, etc., happening to a business or a private goods. Now, you can imagine the importance of business taking out insurance. If your shop gets broken into, your factory burns down, things like that, your stock will be affected. Now, if those things are affected, obviously you're not making a profit, and we're going to look back at the triple bottom line, and one of the pillars would be profit. So if something happens to your business, you're not making a profit, it's a problem. Let's carry on. Now, and like I told you, we are actually buying peace of mind, knowing that in the event of something happening, we are covered. Now, insurance is a short-term financial investment. Now, that means we can cancel it, usually after a year, with no loss to ourselves or other than the premiums that we've already paid. So, quickly to summarize the two, because I don't want to spend too much time on this further. Assurance, assurance, we are assured that something will happen, death. Now, this is compensation for something that will occur. Insurance would be risk or trying to cover risk for something that might occur, fire, theft, something like that. Now, assurance and insurance are two types of insurance that it's non-compulsory, and I need you guys to know this, so write this down. It's non-compulsory insurance. In other words, you, the consumer, have a choice whether you want to buy this insurance or not. What I'm going to do now, I want to look at compulsory insurance. In other words, this is insurance that we pay whether we want to or not. It's compulsory. So let's have a look. The first type of compulsory insurance would be the road accident fund. Now, before I go into too much detail on the road accident fund, because I actually remember reading this in the newspaper this morning, if you were lucky enough to follow or catch the budget, the 2013 budget, you'll see that the road accident fund has gone up, I think, by 8 cents, and price of fuel 22 cents. Please don't quote me, that's what I remember off the top of my head. So the road accident fund is a compulsory fund that every time you go and fill up your car with petrol, or put 50 bucks of petrol in, it actually doesn't matter, you are not only paying for fuel, but you're also paying towards the road accident fund. And let's have a look at what the road accident fund includes. So the road accident fund, or the RAF, is a compulsory form of insurance, and the premiums are funded by the means of a levy on the fuel. So in other words, petrol and diesel sold to drivers and owners of vehicles. So like I said, every time you fill up, you pay towards this. Now, the levy is therefore included in the price of fuel. Now, the road accident fund protects the innocent victims of motor vehicle accidents against financial loss due to injuries sustained as a result of the accident. So a very important part to this is the road accident fund protects innocent victims of road accidents. So you'll see a little bit later on that the person responsible for the accident, their family or the people in the vehicle will not be covered by the road accident fund, because they're actually, unfortunately, part of the guilty party. So remember, road accident fund goes to the innocent of the accident. Now, the negligent or the guilty party, so the negligent driver, is also protected against claims made against him as a result of the accident. So what's meant with that is, so if I sue the person that caused the accident, they can't pay for it, they will have the opportunity to go to the road accident fund and say, this is what happened, I need protection. So the innocent person who got hurt can claim from the fund, and the person who caused the accident, they can't get money from this, but they can ask to be represented. Now, the next part of this, however, the road accident fund does not offer cover for damage to property or for the injuries and death of members of the negligent driver's family who were in the vehicle at the time. So we've looked at that, so remember that, please. Now, the degree of negligence is also taken into account when calculating the compensation to be paid to the injured party. So when they say the degree of negligence, this could be, was the person drunk, were they under the influence of substances, did they have their lights on? So the degree of how irresponsible they were gets taken into account. And the last part to this, compensation includes hospital and medical expenses, proven loss of the income, loss of subsistence and maintenance, and the general compensation of pain, suffering, and disfigurement. Now, with this compensation, it includes basically you got into quite a bad car accident, you need to go to hospital. In theory, the road accident fund will look after the hospital funds. If you have to be booked off for work because you need to go to physio, that time you're not at work, theoretically, you'll be compensated for the time you were not at work, and so on. You'll see later on with, for example, okay, but actually I'm not going to jump ahead because I want to speak with the workman's compensation, but that's the next section. So remember, road accident fund, it's compulsory. You pay it every time you put petrol or diesel in, and it's there to protect people on the road, innocent victims of accidents. Now, I don't want to go to the next section. I want to actually go to a break first, so I'm going to take it over to you,
Thank
and then we'll
you.
carry on.
Thank you, guys. So we're going to go for an extremely short break because there's so much to go through. But you guys need to post your questions on the page, guys. You guys are far too quiet for me today. I need you guys to jump on the page and actually start chatting, maybe to each other, anything that you want to clarify. Maybe you're like, please go back a little bit, Tanya. I didn't really get that. You guys can post it on the page right now. See you after the short break. Welcome back, Mindsetters. Thank you for joining us today for Business Studies. It's been so awesome so far. There's so much information that you guys can get from us that you guys need to go through. That is on our webpage, guys. That is www.learnextra.co.za/live. If you didn't catch that, or you don't want to, I don't know, if you don't want to write it down, you can just pop onto the page because I've just posted the fast link. If you just click on that link, just give it one simple click and it will take you directly to the notes that Tanya are doing. Guys, they're fantastic. You guys need to download them, stick them up on your wall, share them with your friends, anything that you can do just to ensure that you have all this information logged into your brain. Over to you, Tanya.
Cool, thank you. So before the break, remember we looked at non-compulsory insurance, which was assurance and insurance, and then we moved on to looking at compulsory insurance. So the first example of compulsory insurance was the road accident fund. The next one we're going to be looking at is the unemployment fund. Now this you should have a good idea of the unemployment fund from last year, and this year, besides today, we're going to go into quite a bit of detail. So the second type of compulsory insurance would be unemployment. So let's have a look. So the purpose of this insurance is to insure workers against the loss of earnings arising from unemployment and provide them with limited financial support during their efforts to find new employment. So the purpose of the unemployment or unemployment insurance is to give a person literally to give somebody a gap while they're trying to find a job. Now, when you claim for UIF, for example, it's not going to be a full salary, it'll be part of it, but it will still be enough to help you get through those few weeks to get your job. Now, the important thing, and I want you to know this, and I didn't add it in yet, is that UIF can only be claimed if it was an unfortunate, if you can only claim UIF if you weren't fired. If you were fired, there were grounds to be fired on, for example, and you cannot claim it. So keep that in mind. So remember, UIF, you can claim UIF to get you through, to tide you over. The second point, it contributors to the UIF are entitled to unemployment benefits, in other words, getting that money, loss of income due to illness of 14 days or more, and maternity or adoption benefits. So in other words, what they're telling you, you can claim UIF for being unemployed. You can also claim UIF for illness if you've been sick for more than 2 weeks. And lastly, there's two of them, maternity, so while the time before and after you've had a baby, as well as adoption. So there are four examples or four instances where you can claim UIF. So it won't be just for if you've lost your job. It could be, like I said, remember, if you're pregnant, if you've adopted, if you're ill for an extended period of time. Another important thing, the third point here, the worker, employer, and state make equal contributions to the unemployment fund. Now, the fund is administrated by the Department of Labor. Now, in general, for those of you doing accounting, which if you watched the show earlier, there should be some of you doing both of our subjects, but your employer will contribute an equal amount to UIF. So you will contribute an amount as well as your employer. And again, guys, UIF, it's one of those things. If you ever become unemployed and you've been contributing, you can claim. But if you never become unemployed, you can never claim. Okay, so that's an important part to remember here. So this type of insurance, again, you can only claim it if it happens, like fire, like theft, only if it happens. The third type of compulsory insurance would be workman's compensation. Let's have a look. Now, workman's compensation, so workers are subject to a number of workplace injuries each day. So you work in a factory, something could go wrong. So people face dangers every day. Now, the Compensation for Occupational Injuries and Diseases Act, or COID, provides cover for both employees and employers in the case of injuries or diseases contracted in the course of the employment. So very important, I want you guys to understand that workman's compensation can only be claimed if you are working for a company. So if you're a miner and you contracted a lung disease, for example, because of bad safety equipment, you can then claim workman's compensation because you were working for the mine and this happened. Obviously, if you just randomly contracted lung disease of sorts, you cannot claim workman's compensation because it was happening in the act of your daily life. Now, the second point to your workman's compensation is the fund is administered by a compensation commissioner and provides compensation to workers and their dependents for medical expenses and for the loss of life of the deceased. So workman's compensation will pay out to you if you're alive, or it will pay to your dependents, in other words, your husband or wife and children. And it will pay out whether you are still sick, or it will pay out if you pass away. The last point, just second last, it also covers employers for claims made against them by workers. So it protects employers against workers as well. Remember, it's a two-way street, yeah? And the last part here, employers must report all accidents within 7 days and occupational diseases within 14 days to the commissioner. So, as an employer, you have the responsibility to report which was the first one, a accident within 7 days. In other words, you have a week to report an accident, and you have 14 days or 2 weeks to report a disease. Now, the importance of this is, obviously, if something happens on your premises, you've got a whole lot of other things happening there. So you'll have insurance. So if something happens, you'll have to contact your insurance company. You will also have to contact the police because there was an incident, as well as reporting this to workman's compensation within a specific period of time. So there's a lot of responsibility coming from the employer towards employees. But the nice thing with workman's comp, please remember that they are also protected to a large extent. So those were the 3 types of non-compulsory insurance. And I'm going to say this one more time because you guys have a habit of forgetting this. Non-compulsory insurance, it will happen or insurance in general, it will only compensate you or pay you out if the event occurs. A big if. Remember, assurance, it's something that will happen. So I've spent the last section now looking at assurance and insurance. I want to look at types of investments now. So let's go. Investments. The first type, oh, good grief. I get, like I told you, Katejo, I get excited and I just want to carry on.
Yeah.
There's one more thing I want to do. It's called the average clause. Now, the average clause, so I apologize quite humbly. We're going to do one more thing on insurance and insurance. So with insurance, you get an average clause. Now, the average clause, quite briefly, looks at how you insure things. So I've got a car, it's worth 100,000 Rand. Now, I could either insure that car the logical thing would be to insure the car for 100,000 Rand because that's its worth. But with the average clause, it comes in if I choose to insure my car rather for 80,000 Rand because I want to pay less on premiums, and that will be called underinsurance. On the other hand, I could choose to insure my car for 120,000 Rand, which will obviously be overinsurance. And I quickly want to show you what will happen with over and underinsurance. And there's a little calculation that goes with this section. And they have asked it in previous papers. So if you don't know this calculation, if you don't know the formula, it's not really a formula. If you don't know how to do it, pen and paper, guys, very, very important. So the average clause. So like I said, this clause stipulates that if goods or buildings are not insured for their full value, the total amount or value will not be paid out. Now, this clause provides for underinsurance and overinsurance. So let's have a look at the first part. What is underinsurance? Now, underinsurance is a dead giveaway here, guys. Let's not forget that. So this is when goods are insured for less than their full value. So the insurance company will then average out the claim, and the full value of the claim will not be paid out. Very important. The principle, or one of the principles of insurance, would be that nobody gains financially. In other words, I can't insure my car for 120,000 Rand when it's only worth 100,000 Rand and sort of like get a little bonus because I spend extra money. So insurance companies will never pay you extra or over and above what the worth is because you're not supposed to make a profit. So let's have a look at a quick calculation here. So the compensation for a claim in the event of underinsurance is calculated as follows. And I put a little example in here for you. Let me change colors. So the insured value is 100,000 Rand. So remember, let's use my car as an example. So the insured value is 100,000 Rand. However, you have covered it for, however you should have covered it for 200,000 Rand. So it should be covered for 200,000 Rand. You wanted to save money and you only insured it for 100,000 Rand. Now, you are therefore underinsured by 100,000 Rand. How did I get that? It's the 200,000 minus the 100,000, which will give us the underinsured amount of 100,000. Now, a fire causes damage to your stock. Okay, so I've jumped around a little bit. Sorry, guys. Worth 50,000 Rand. So the example I used here was it's a factory. It's worth 200,000 Rand. You've insured it for 100,000 Rand, and a fire broke out. Remember, this is a random act. And the fire caused 50,000 Rands worth of damage. Now, the insurance company will only pay you out for what you have covered. Remember, you've underinsured this now. So this is the calculation. So it's going to be 100,000 Rand over 200,000. So the 100,000 Rand was the insured. Let me quickly grab a pen again, sorry. The 100,000 Rand was the insured value, so that's how much you insured it for. And the 200,000 Rand was the actual value. And you're going to times this with the damage or loss that occurred. So you insured it for 100,000 Rand. It was actually worth 200,000 Rand. A fire broke out, caused 50,000 Rands worth of damage. If you do a quick calculation, you'll see that it comes out to be 25,000 Rand. Now, what does this mean? So you will only be paid out 25,000 Rand in this claim. And then you can see how critical it is not to be underinsured. So the point of this is you look at, with underinsurance, you get paid out for what you've insured it for. So in this case, there was 50,000 Rands damage. You only insured half of it. You only get 25,000 Rand. As easy as that. Then quickly, overinsurance, again, dead giveaway. Now, a building is overinsured if it's insured for more than its actual value. So, for example, a building worth 300,000 Rand is insured for 400,000 Rand. That's a whole 100,000 Rand more than it's worth. Now, the insurer may exercise the right of reinstatement, which basically means that they have the right to rebuild or replace the goods and not pay you the actual money. Now, further, you will have to, you would have wasted money on the higher premium. Remember, we said that you cannot make a profit on insurance claims. So, sure, Katejo, I just went overboard. I told you I get excited. Insurance, assurance. We're going to now go to investments. So investments, again, I'm not too stressed. You've done this in grade 11. The first type of investment we're going to look at are shares. Now, what I've done is I've summarized the 4 basic types of shares. And let's have a quick look before we go to our ad break. So I'm not going to go into a whole lot of explanation of shares. Basically, remember, shares you buy from listed companies, in other words, on the JSE, companies, private public companies. Remember, you've done this in forms of ownership. We're also going to be doing forms of ownership at a later stage. So don't stress too much if you're a little fuzzy on that. And also, just as a random fact, remember, companies, public companies, are end with LTD, in other words, limited. So let's quickly have a look at those shares, what types of shares you get. So, next slide. Types of shares. Now, there are 4 important classes of shares. The first type, preference shares. Now, the holders of these shares are entitled to a fixed percentage preference dividend, and this is calculated on the normal par value of the shares or the issued par value of the preference share. The second type of shares you get would be ordinary shares. Now, these shareholders, the shareholder is entitled to receive dividends after the preference shares have been paid out. The third type would be founder shares. Now, these are issued to the promoters and are the last in line to receive dividends. And the last type of shares I want to show you today would be bonus shares. Now, bonus shares are sometimes issued in place of dividends in the years when a company does not declare a dividend but uses the profits for expansion. So a lot of times companies want to expand, and instead of paying the shares out, they would rather build the business up. And let's stop with that. So let's quickly go to a break.
Yeah, let's go to a break before you get carried
Yes.
away again. I know most of you guys are like, no, please, no break. This is only just getting exciting. I know, guys, but some of you guys, I know you need some water or to take a bit of a stretch, or even those pens are writing so fast that you need to go fill them or get another one. We'll see you right after this short break. Welcome back, Mindsetters. Business studies has been so fantastic so far. Most of you have mentioned it as one of your favorite subjects, and that's fantastic to hear, guys. It means that you guys can also jump on the page and help other people who may not be understanding as well as you. So jump on the page, give it a try, meet people. Guys, there's so many Mindsetters out there. You guys need to meet each other because this is so awesome that you guys have a full page all to yourselves. And I've just noticed now that we are literally 10 likes away from the 32,000 mark, guys. You guys need to call those aunts, uncles, cousins, brothers, sisters, grannies, anyone you know who has Facebook, and anyone you know that absolutely loves Mindset. We should change that like button to love, because I think that like is just like a bit too casual for us. We need that love button. So you guys need to start clicking on that so that we can reach 32,000. I'm hoping to reach it by the end of the show, guys. So make sure that you jump on that right away. Over to you, Tanya.
Awesome. So before the break, I started speaking about shares. Now what I want to do is I'd rather do questions with you. So the thing I'm going to leave out unit trusts, fixed deposits, and debentures. So if you're feeling a little bit stressed about it, you can always go on the website. Remember, we posted a fast link.
Yeah.
But no worries, I will cover it. So remember, big up to Macmillan for helping us out, sponsoring the show. So if you've got your Macmillan textbook, you can follow me with this question. So this is activity 5. It's on page 105, and it looks at insurance. Now, the question asks you, study the pictures in the illustration and then identify the various risks in each of them. So let's have a look at the first one. What's happening here? We've got a fireman, there's a factory, and quite clearly there's some flames happening here. So what is the first type of risk here? It's a factory on fire, so it's a fire risk. Cool. So the second one, we've got a woman breaking into well, it clearly looks like she's breaking into a clothing shop. So this will be theft. Let's quickly label this one. This would be fire. Let's have a look at the next picture. This guy is standing in a shop. Looks like there's some CDs, things happening in the background, maybe DVDs. Oh, there we go, DVD. What is he doing? He's stealing. So again, this would be an example of theft. So theft, and I lost my pen, let me quickly grab it again. So this is theft. And the last one, there's some bad guys, and this is, you can see this is a cash and transit truck. So this is an example of a cash in transit type of robbery. So the question was, I didn't ask you to write anything down, I just asked you to identify. So basically, to get you thinking. The first question here says, what must the factory owner do as soon as possible after the outbreak of a fire? Now, think about this logically. A fire broke out. There's a couple of things you need to do, guys. The first thing would be, there's a fire. What are you going to do? You're going to phone the fire department. Second, you will phone the police. And thirdly, remember, we're looking at insurance. Your business just burned down. You have to contact your insurance company. So let's quickly write these down. So what must the factory owner do as soon as possible? First off, phone the police. So it'll be police. Then, you see, I hope you're concentrating there. So second thing would be police. First thing would be the fire department. And the third thing they need to do would be to get hold of their insurance company. So that was a nice, easy question, basically 3 marks. Question B, the factory building and the contents of the first example. Remember, the first example was the fire. The factory building and the contents are insured for 1.4 million rand. But the insurance agent determined the full value at 1.8 million rand. So they insured it for 1.4, it was actually worth 1.8. How did he determine the value of the building and the stock if the damage was extensive? Now, this is pretty easy in this day and age, guys. You will have records of things being appraised, you will have records of what things cost. So literally the answer to this question is records kept. So how will they know it's worth 1.8? Because the company has kept records. So let's quickly write this down. So for B, would be records kept. Now these records, in other words, invoices, appraisals, things like that, will have to be kept in a fireproof safe, as well as these type of records in this type of instance. There will also be something called an iron safe clause. Now this basically means you have to keep your records. In the old days, you would literally have to keep your records in a big old-fashioned safe that is fireproof. So if a fire broke out, everything would have been burnt down and the safe would have been standing. Why? So that you can prove the value of your company. These days, obviously, we've got amazing internet stuff. So we've got iCloud, we can save things externally. But I would imagine some companies will still have the good old-fashioned thing, as well as the technological backup. Question C, on your textbook, it would be number 3, asks us, in calculating the amount to be paid to the factory owner, which clause of the insurance contract would the agent have to take into account? Hopefully, as I was reading this, you were going, oh, please, we've just done this. It's the average clause. So remember, that was insured for 1.4. The agent worked out it was worth 1.8. So it would be the average clause, and more specifically, what? Under insurance. So let's write this down. So the first part, yeah. So what is it? It would fall under the average clause. And it would be a prime example of under insurance. Let's have a look at the next question. The next question is asking us, will the full amount of any claim be paid out to the factory owner? Motivate your answer. And the answer simply would be no. Why? Because it was underinsured. And the last question here, this is a calculation, some of my favorite things to do. So how much would the factory owner receive if the damages amounted to 500,000 Rand? Show all your workings. Remember, if they ask for it, do it, guys. So grab your pens, piece of paper. If you're not too sure on the calculation, let's do this together. So it would be 1.4 million. Oh, I'm all over the show. Yeah, just give me a sec. I want to erase this. So it is the 1.4 million over the 1.8 million. Just make sure I've got enough zeros here. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yes. Times the amount of loss, which in this case was 500,000 Rand. And if you quickly take your calculators, you will see that this works out to be 388,888.88. Now, those of you who got a little bit lost here, remember, what are we doing? We are looking at how much would the factory owner be paid out if the damage was worth 500,000 Rand. Now, if you're a little if you forget easily, remember 1.4 million was the amount it was insured for. So this was the insured amount divided by the actual value times by the loss. So because this person chose to underinsure their goods by 400,000 Rand, they literally, because they suffered a loss, they suffered an even greater loss because they're underinsured. So that was question 1. Let's have a break.
Let's have a break, Tanya. So guys, there's a lot more after the break. Please, for this break, do not move off those seats, guys. We need you back promptly because there is still a lot to go through. So see you just now. Welcome back, Mindsetters. I know you've been enjoying the show, and it's so stunning to hear. That's probably why you guys don't have many questions, but it's reached that time of the lesson where if you do have questions, guys, or if you just need to clarify on something, asking a question is okay. Not asking it is where you will actually lose marks. So it's actually very silly not to ask those questions that have actually been bothering you. So please shoot them over to the page right now. And most of you have already downloaded your notes, but if you haven't, please download your notes, guys. It really, really is going to help you. Or if you know someone who can't download their notes and you have them, share them with them, guys. Do your random act of kindness, do your goodwill for the day, and help someone else. It always helps you as well. It comes back tenfold, so do it, guys. It really helps. Over to you, Tanya.
Cool, guys. So before the break, we did a quick exercise looking at insurance. The next question I took was from a previous paper, an exam question. And this is a nice, easy one. The majority of you, actually, I want to go one further. All of you should be able to calculate simple interest at this stage, but I want to do this question with you. So let's have a look at question 2. So question 2 says, Basil invested 10,000 Rand of his annual bonus in a fixed deposit account at Standard Bank, earning an interest rate of 12% per annum. The question asks, using the simple interest method, calculate the return earned by Basil over a period of 12 months. So let's have a quick look here, and it's worth 4 marks, so you can see even this, it's a quick, easy question to do. So the answer is going to, let me quickly find it. I'm sorry, I'm going to show you the formula. So what are we asking, or what are they asking? They're asking us, using the simple interest method, calculate the return. So I've got a little formula here, but you, and whatever type of calculation you want to use, go for it as long as we get to the same answer. So the interest he received, or how much did he get back, what was his return? So P times R times T, and remember, P would be the initial amount, R is the interest, and T would be the duration. So let's have a quick look at this calculation. So it's going to basically look like this. So what was the initial amount? The initial amount was 10,000 Rand. So it's going to be 10,000 Rand times the interest, and the interest they told us was 12% per annum. So that's 12 over 100 times the duration, and they told us it's over 12 months. So we know it's going to be 12 over 12. And before I give you the answer here, again, it doesn't really matter which formula you use as long as we get to the same answer. And when you've worked it out, his return was 1,200 Rand on his initial investment of 10,000 Rand. That's not a bad return at all for a year's investment. So the next question follows on to this, and it asks us, give 2 reasons why Basil's investment in a fixed deposit account is good. So the 2 reasons for this is, a fixed deposit account would be low risk, and the second reason that this would be a good investment would be a return of 12%, which is quite high, is better than many forms many forms of other types of investments. So 2 reasons. 1, it's low risk, and 2, 12% is a pretty good return. Now, what I want you to add in there, if you're not going to remember this, remember with investments, high risk, high return, low risk, low return in general. So with high risk, what I mean with a high risk investment, it means you can either do extremely well or you could literally lose everything. So sometimes a good example of a high risk investment would be shares, where depending on what's happening in the economy, your shares could go up 200% in value, or something happens like a global recession, which we recently had, and company just fails, and there you've lost everything. Where if you put your money in a deposit or a fixed deposit, it's pretty safe. So it's low risk, but you'll also have a low return. This example, or this question of the 12%, is pretty high for a fixed deposit. So if you get this question, just keep that in mind. The third question I want to do with you today, again, it's from a previous paper, the November 2009 paper. The question is, Zamisa Zulu bought 100,000 ordinary shares. Remember, we looked at what ordinary shares are. Bought 100,000 ordinary shares at R2 per share from a public company listed on the Johannesburg Security Exchange. At the end of the financial year, he received his first dividend check of 40,000 Rand from the company. The question is, calculate the percentage return on investment received by Zamisa. Now, grab your pen, paper, do this with me. So, how are we going to work this out, or how are we going to calculate this? The formula for a return on investment looks like this. So, write this down if you don't know it. Your return on investment, I'm going to abbreviate that slightly. Your return on investment looks like this. So, it's return over your amount invested. Again, I'm abbreviating this, I'm sorry, amount invested times 100. Why times 100, guys? Remember, we are calculating a percentage. Whenever you calculate a percentage, you need the 100 there to give you the percentage. So the question asked us, what was the rate of a return? Whenever they asked that, you can use this formula. So let's have a look at the question. It said, he bought 100,000 shares. I'm going to change my pen quickly. He bought 100,000 shares at R2 a share, and at the end of the financial year, which was 1 year, he received 40,000 Rand. Calculate their percentage return. So the return was, we know he received the 40,000. So it's going to look like this. 40,000 over the amount he invested. How much did he invest? He bought 100,000 shares at R2 a share. So don't confuse this. Remember, he bought 100,000 shares at R2 a share times 100, which will mean that he received a 20% return. So that is an exceptional return on investment, guys. 20% increase, this is a good investment. So again, when you asked to calculate the return, I'm speaking in riddles here. The return on investment, remember, it's the amount that you've invested, or okay, let's start this again. So
Tongue twister there.
tongue twister. So it's your return on investment. How do you calculate this? It's your return over the amount invested times 100, because it's a percentage. The second question here, and I think, yes, I'll be able to squeeze it in. I'm very excited. The second question is, will Zamisa be happy with his return on his investment? Motivate your answer, and it's worth 4. So I've already told you that I don't know about him, but I will definitely be happy. So the answer here would be yes, he would definitely be happy with his 20%. Why? The first reason would be it is a really high return. So it's a high return, and it's a high return in relation to, for example, a fixed deposit. And I just want to remind you guys, remember, high return, high risk. And also, why would this be a good investment? This would be a good investment because it is simply higher than the inflation rate. So he is keeping ahead of the game, and not just keeping ahead of the game, he is actually making a profit. So, wow, I had such a cool day today. I love investments, I love insurance, I love assurance. Now, in a later show, we're going to go into a lot of detail and calculations. With the insurance, assurance, investment section, you will be required to be able to calculate a return on investment, cost of shares. You need to be able to do calculations on underinsurance, for example. So if you have a slight phobia, because there are some of you out there with a phobia for maths, watch Mindset.
Yeah.
That really is the easiest.
That's number one.
That's number one. Number two, you should actually just chill, guys. These things, I will go through it with you, and it's like everything else in life. You practice these calculations, and you'll do well. A lot of these times, these calculations are really simple, so they're free marks. So I hope you've enjoyed today's show. Like I said, insurance, awesome stuff. And last word, remember, assurance, it's something that will happen, guys. Over to you.
Thank you. So, guys, thank you for such a fantastic show. You guys had fun. I can see it on the page. We definitely had fun here. We need you guys to join us every week, same time, same place. Thank you to Macmillan for bringing us such an awesome show, guys. Without them, then you wouldn't have us. So thank you to them, and thank you to you for joining us, guys. Keep helping each other on the page. Keep learning more and keep learning extra, guys. Never, never, never stop learning, because it'll open up some great doors for you guys. Thank you from us at Mindset. Bye-bye.
Extra. Let's do the next point. So a retirement annuity policy can only mature once you've reached retirement age. And currently this is 55 years old or older. Now the very important word here, guys, retirement annuity policies can only mature once you've reached retirement age. So you can't take out a retirement annuity, for example, and decide you want to retire at 35 and you're going to take the money. So according to current law, the youngest age you can retire at would be 55, and then you can start claiming the benefits of your retirement annuity. If you rather want that money, if you think, you know what, I want to be a millionaire by the time I'm 35, rather take that money and put it in unit trusts or something like that, because those don't have the same legal requirements, for example, as an RA, which would require you to be a certain age before you can reap the benefits. I'm not going to go into too much detail on the RA. I want to go into insurance. So let's have a look. Insurance. You can also, what I don't cover, you can always grab the notes. So what is insurance? Now, insurance is a contract where a company, the insurer, undertakes in return for receiving a premium from the insured, the person who's buying the insurance, to compensate the insured in the event of a specific event occurring. Wow, that's a really big sentence. Let me make that short and easy to understand. So insurance is basically you taking out a policy to protect you against theft, fire, something like that, and the company will take that risk on the basis that you're going to pay them for it. And now this will provide for the dependents, but also provides a useful sum of money for the insured if they survive the period. And what's meant with surviving the period is literally, if you decide you want to retire at 65, for example, you will receive money. It could be either in a form of a lump sum, monthly, but that will look after you when you've reached 65. And in the case of this, like the definition tells us, it will be on your retirement or on death. Now, obviously, with death, your family will reap the benefits of the money you've put away. Let's carry on. The next page looks at retirement annuities. So following on, and you need to know this in grade 12, following on from assurance would be retirement annuities. Now, retirement annuities and pension funds go hand in hand. The difference between the two really essentially, what you need to know at this stage would be the tax implications of the difference between a pension fund and retirement annuity. And the nice thing is you don't have to know that in detail, you just have to know that there's a difference. So let's have a look at a retirement annuity. Now, a retirement annuity, or an RA, which is the abbreviation, is a personal pension plan for retirement. So when you stop working. Now, you pay a monthly, annual, or lump sum contribution, and these funds are then invested by the insurance company. So with a retirement annuity, the company takes your money and invests it for you. So it takes the responsibility or that stress away from you. So on retirement, you get the money you put in, plus I should have done quite a bit of forms of ownership. So when we get there, just get on the bus, and as we go through it quite quickly, we can do it. So let's do the first thing, assurance. Let me find the slide. And that's what we're doing. And assurance. Now, assurance and insurance, the easiest way to remember between the two, there are very few things in life you can be assured of. And as I said that, I'm sure the majority of you already thought of that. So assurance is basically a type of a type of insurance for something that will happen. Now think about this logically. What is the one thing that will happen to all of us? Death. As sad and as what it is, just the easy way to remember. So we're all assured of death. So assurance is a type of insurance for when you pass away or when you retire. So let's have a look at the definition. So assurance is a long-term life insurance providing cover for your life, health, and well-being. Now, individuals can insure their lives so that in the event of death, business partners or family members will receive an agreed sum of money. Now, life insurance policies can be used as security by individuals or businesses to obtain loans. So I want to get up to there. So with assurance, people assure their lives to look after their families, for example, after they pass away. We're going to look at types of insurance shortly. But people can also use assurance, these policies.
Hello guys, welcome to Learn Extra Live. Grade 12s, it's finally business studies. I know you guys have been dying for it all week, but yes, we are here, and we are here to save your lives. I know we always save your lives. But of course, you can join us on Facebook, facebook.com/LearnExtra. Our Twitter handle is @LearnExtra. These are the platforms where you guys can get chatting to us, ask any questions that you need to ask about business studies. Let's get into it, guys. I mean, it's such an interesting topic. Today we're doing, Tanya, do you want to let us know what we're doing today?
Today we're going to be doing one of my favorite topics. Today we're going to be looking at insurance, assurance, and types of investments. So yes, today I'm going to get really excited.
Okay, thank you, Tanya. You hear that? We're going to get exciting today and excited. Make sure that you jump onto the page, guys. It's really, really important that you guys ask Tanya questions, because that's what she's here for. And thank you to Macmillan for bringing us such an awesome session, guys. We really enjoy having you guys and Macmillan here. So, hey, stay with us and you will go far, I promise you. Over to you, Tanya.
Cool. So guys, like I said, assurance, insurance, investments. The first thing I want to look at, we're going to start with assurance, get into a little bit of detail, then insurance, and then very, very briefly we're going to go into types of investments, and that touches on forms of ownership. At this stage, you can to seed against bank loans, for example. So, for example, if you want to take out a loan, you have to give something in return, or not give something in return, have something available for the bank. And you can use these policies to loan money. So that's it's a handy thing. So let's carry on with this. Now, life assurance can be bought directly from a company or through a financial service. So you can either choose to do it yourself or through someone else. But what I really want to get into is this part here. So in the case of assurance, cover is provided against a risk that will happen, death. Like we've discussed, so remember, assurance, it's something that will happen, and we all know this will happen. So the two main types really of assurance, the first one is whole life policy, which provides for a payment after the death of the insured, with the idea of providing for the dependents of the deceased. So a whole life policy really looks at only after a person has passed away and money that's been kept to look after that family. So somebody passes away, obviously there are people left behind, and those people need money to survive. So a whole life policy looks at looking after your family after you've passed away. Then you get a second type, or one of the two main types. So the second type would be an endowment policy, which will provide for the payment of a basic sum at a certain age, or on death of the insured, whichever one occurs first. That makes a lot of sense.